With the trend change from growth to value companies in our current market environment, I wanted to find a firm that traded well below its average multiples, was supported by a strong and growing market share, and has a solid dividend yield. A top-down macroeconomic approach of the housing market led me to First American Financial Corporation, which I believe displays all of the previous characteristics along with exciting potential for digital growth in a new and emerging space. First American Financial Corporation is the second largest title insurer with a 28.8% market share domestically. The largest amount of revenue, or 79%, comes from premiums and escrow fees, which increased 14% year over year in 2020. A rapidly growing information segment, fueled by the acquisition of Docutech, accounted for 14% of revenue in 2020, and the rest came from investment income. First American was spun off in 2008 from its original company, the First American Corporation, but has been underwriting since 1889 and has a strong proprietary database built. The firm is headquartered in Santa Ana, California. First American represents a great value play as it trades at only 10 times its forward earnings, which is well below the 5-year average of 14 times. It also yields a strong 3.68% dividend, which has grown at a compounded annual growth rate of 16.5% over the last 5 years. Additionally, they've just gone into a book transfer agreement to sell the property and casualty business. This segment operated at a $31 million loss last year and could likely be very hard to underwrite for going forward, as an increase in natural disasters seems to happen every year. Finally, management has doubled down on their belief that shares are trading well below their intrinsic value with an aggressive $300 million share repurchase plan. This comes after $139 million was rebought throughout 2020. With all of this and my drivers in mind, it is recommended that First American Financial be added to the AIM Small Cap Fund with a price target of $71.80, representing an upside of 27.12%. The first driver is related to a strong outlook in the commercial and residential markets. While commercial volumes dropped significantly in 2020 due to the pandemic, residential markets remained fairly resilient, with transactions increasing by 5.6% year over year in 2020. A large amount of this was fueled by interest rates, but also families realizing that some of them had two parents working from home and several children attending school remotely, looking for a larger space to live in. Home sales are estimated to increase by 10% in 2021, with January new home constructions beating consensus at an increase of 22.5% year over year. Additionally, millennials now make up the largest amount of new home buyers at 35%, as a trend from ditching apartments to have their own home equity is now surfacing. Finally, commercial transactions are set to rebound in 2021. A Q4 commercial volume year-over-year decrease of only 5% still beat the consensus and points towards a healthy rebound. It's very possible that a large amount of these deals that were placed on hold due to the pandemic could re-enter the market in 2021, as the commercial industry increases overall. The second driver for First American is a strong eligible refinance base. When refinancing a home mortgage, a new title insurance policy is required as the loan is no longer valid on the old mortgage. In 2020, historically low interest rates drove refinancing volume up 105% year over year. And while it's unlikely to remain at these high levels, there are still 16.7 million Americans that are eligible to save up to 75 basis points through refinancing. This is assuming that they have a FICO score above 720 and at least a 20% equity down payment on their home. Currently, the 10-year and 30-year yields have upticked, and with interest rates increasing, it will slow refinance volumes from what they were in 2020. But we're still in a historically low mortgage rate environment that will drive home sales and refinance volume. The third and final driver for First American's business model are their recent digital investments. This includes a 2020 $350 million acquisition of DocuTech, an e-closing, e-sign, and compliance fintech platform that's utilized by over 175 major lenders. This increased marginal efficiency as 32% more closed orders took place in 2020, while only 6% more personnel were hired. It's also largely attributed to increasing the information revenue segment 38% year over year. Also, $200 million have recently been invested in venture startups to keep First American into the digital space and stay relevant with younger generations. A great example of this, Endpoint Closing, which provides digital escrow and other mortgage-related services, is incredibly successful and is starting to take off on the West Coast. To reach my final valuation, an excess equity model was created with a 5-year time span instead of a DCF, as this is the most relevant to the industry. Using a cost of equity of 9.54% and a terminal growth rate of 1.5, a final valuation of $83.29 was achieved. Next, a price-to-book multiple was used using a peer average of 1.26 times. This resulted in a valuation of $55.84. Finally, a price-to-earnings model was built using a peer multiple of 8.55 times, resulting in $53.28. Ultimately, these were weighted 60, 20, 20, and resulted in a price target of $71.80, representing an upside of 27.12%. Additionally, sensitivity analysis was done on the excess equity model with plus or minus 100 bips, resulting in a range of $69.76 to $105.22. Risks to First American's business model include cyclicality within the housing market, as changes in supply, demand, and interest rates all drive home transactions. A sudden downturn in this volume could have a significant impact on First American's top-line growth. There's an intense rivalry in the space, where the 4 major title insurers are forced to compete amongst themselves with only a few banks that hold the majority of mortgages. This can result in significant shift in market share in only a short time. And finally, there are several alternative fintech solutions entering the space. And while it does pose a threat to capture market share, First American has done a great job, but will have to continue spending in this area to stay relevant. First American's management team is comprised of Mr. Dennis Gilmore, who currently serves as the CEO and director and has since 2010. He's been with First American since 1993 and also previously held the role of president at CoreLogic Solutions, a company which specializes in data aggregation within the housing market. Mark Seaton has been the CFO and executive vice president since 2013. Previously, he was senior vice president of finance and director of investor relations within the company. Mr. Parker Kennedy is currently the chairman of the board and brings 40 years of relevant experience, including previously having been First American CEO and president. In conclusion, First American Financial represents a value play supported by their current 28.8% market share. The company is trading well below its average forward multiples of 14 times forward earnings, and digitalized efficiency and the sale of their property and casualty insurance support marginal growth going forward. If you have any questions, feel free to contact